Okay, good morning, good evening, and welcome to today's session. So, we want to look at the accounting for leases in reference to the lessee. That will be our subject of discussion today, and this is our third topic as far as accounting for liabilities is concerned. Now, from the framework perspective, accounting for leases is normally guided by FRS number 16, but previously it was guided by IAS number 17, but because of some few development which we are going to see later in this topic, that change was necessitated. So now the expectations from this topic will be one. At the end of the presentation, you should be able to explain the nature, the economic substance, and advantages of lease transaction. You should be able to describe the accounting criteria and procedure for capitalizing leases by the lessee. You should be able to give a clear contrast on the operating and capitalization method of recording leases. You should be able to identify the special features of lease arrangement that causes unique accounting problem, and you should describe the effect of residual value, guaranteed and unguaranteed on lease accounting. And finally, you should be able to list the disclosure requirement of the leases, among other things that we'll interact with in the course of this particular presentation. Now, in terms of definition, we normally say a lease is a contract where the lessor conveys to the lessee the right to use an asset for a specified period in exchange for payment. So the lease we are discussing about, it may not be very different from the lease that you have for the unit of the house that you do occupy. Now, in this case, you appreciate the fact that you have paid the occupancy of that particular house for a period of 1 month. So that's the time that you own that house. So for your case, you are the lessee, you are the tenant. So lessee is also called the tenant, and then we have the lessor, who is the landlord, the person who have given you the right to use that facility in the exchange of money. So we have these two main parties. We have the lessor, and this is the legal owner of the asset who grant the right to use that asset to another party called the lessee for a specified period in exchange for periodic payment. So the, the landlord or the lessor is the owner and normally give you the right to use that property for a specified period, maybe 1 year or whichever the period that you have agreed, in exchange of periodic payments. And these periodic payments, they are called lease rentals. LSC is the party that obtains the right to use an asset from a lessor for a specified period in exchange for agreed upon lease payment. So a lessee is now the person who is given the right to use that particular asset. You as the tenant, you are the one who is called the lessee. Then we have the players in the lease environment. The first one is the bank, the second one is the leasing companies, and the other one is the independent company. So these are the people, or these are the parties who participate actively in the leasing environment. For example, you can find the bank normally give um, the lease. You can buy a motor vehicle, you can pay some leases, you can have the asset, you can have the equipment, and the bank normally play a big role as an intermediary in this transaction. Then we have the leasing companies. So these are the companies who engage in the business of leasing. And then we can also have the independent company. This independent company can act as valuers, can act also as lease agent, etc. All right. So the largest group of leased equipment. So these are the equipment which are normally leased. Mostly the list is not limited, but these are just the largest equipment. One is information technology. So with the advent of information technology, there are companies who are coming up with a list arrangement where, for example, if you are starting a business, instead of you incurring the heavy cost of servers and all those other IT infrastructure, you can be able to lease a space, yeah, from these leasing companies. There's a company called Icoro. You can Google at your own time, and you can see exactly what they do in this business of leasing spaces in their servers. Transportation, so you can lease a truck, you can lease aircraft, which is very popular with our politician, or you can also lease maybe a railway to transport industrial good, maybe from maybe Mombasa or from one port to the destination. Construction, you can hire construction equipment, and you can also hire the agricultural equipment, especially the tractors and any other heavy machinery which is required in the agriculture sector. Now let us look at the advantages of leasing to the lessee. So now take a case where maybe you want to have a holiday or a vacation and you don't have money to buy a motor vehicle. You don't have the half a million Kenya shillings to buy maybe a simple motor vehicle. So you can go for leasing, which costs you maybe 2,000 Kenya shillings per day, which is a bit affordable. That is the advantage that we are talking about. You may not have the initial capital outlay to buy the equipment, but you may have the capital to lease an asset. So one of the advantages is that it conserves capital, and we say no large upfront payment required, unlike purchasing. So when you are purchasing a motor vehicle, you need a large sum of money, but when you are leasing, you don't require large sum of money. The other one is easy access to the asset. So it enables the acquisition of high cost asset, e.g. machinery or vehicle, without the full ownership. So for example, if the lease will enable you to access this asset very easily without having to own the asset. The other one is the flexibility, and this is in terms of the lease, the duration of payment can be negotiated to fit business need. So if, for example, you want to hire a motor vehicle for 2 or 3 days, this is the best way to go. If you want to hire aircraft for 2 hours or 3 hours, then this is the way to go. The other one is the tax benefit. So we have the lease expenses, which are normally deductible. In Kenya, lease expenses are deductible, and that means they are going to help you to reduce your tax liability that you pay to the revenue authority. So risk reduction, the lessor often handles maintenance and residual value risk, especially in operating lease. So risk reduction, it is whereby the lessor takes care of any risk. For example, the building that you live, because in most cases the one for building they are normally operating, they are normally um, extended to a 1 year period. You find that the owner or the lessor is the one who pays the insurance if there is any. If you hire a motor vehicle for 2 days, it is the owner or it is the lessor who will bear the cost of the insurance cost for risk reduction or risk mitigation. Technology update. If, for example, you have hired an IT infrastructure, it is the work of the lessor to ensure that the updates are done as and when required. So those are the advantages of leasing to the lessee. There might be other, but for now, we are going to limit ourselves to those ones. Now, we also have the disadvantages of leasing toward the lessee, and the first one is that no ownership right. So the lessee never owns the asset, unlike where there is a purchase option. Even if, for example, you stay in that one house unit or two house unit or whichever the capacity of the unit that you have, you never own it. Unless now we have other arrangement which we are going to which we are going to discuss about the uh, lend to own arrangement. But in this case, if it's an operating lease, you don't have an option to buy at the end, then that house or that particular unit that you have leased will never be yours. Higher long-term cost. Over the time, lease payment may exceed the cost of buying the asset. So sometimes you find that if it's a motor vehicle, for example, you have hired a motor vehicle for, let's say, for 1 year, and you are paying, let's say, 2,000 shillings or 3,000 shillings per day. If you do the maths correctly, you may find that the cost of hiring is more higher than the cost of buying that particular asset. And that's why you are an accountant, you have to figure out on this kind of capital decisions. Obligation to pay. So the lease agreement are abiding. Payment must be made even if the asset is no longer useful. So if you have entered into a long-term lease, for example, you have leased a house to have a shop for, let's say, 12 months, and maybe you have paid upfront, because there are some leases which require you to pay upfront payment. You have paid a deposit of 6 months. So the payment that you have made, even if you're not utilizing that particular leased asset, those payments, in most cases, they are not refundable, and that one is a waste of resources. And again, because you are afraid of breaching the contract, you know, so you are obliged to pay even for the period that you have not utilized the property or the asset. The other one is restriction of the use. So lease may face limitation on asset use, customization, and subleasing. In most cases, if you look at the lease agreement, it normally limits you even for the house. You know, you can't say that because you have leased one bedroom that you look for your friend and you partner, you know, or you sublease one unit to them. That's not normally not allowed. Or you say that yes, I have leased one bedroom, I'll divide it into three single rooms and then I can rent it out. That one again is not allowed. So you cannot sublease or customize that particular. Customizing is maybe doing some modification to suit your personal need. So this one is not allowed in a lease arrangement. The other one is financial reporting required. So lease must recognize, so let the lessee must recognize lease liability and right of use, which can affect the financial ratio. So this is one of the changes that came from IAS 17 to IFRS 16, where we have the lessee must recognize lease liability and right of use. And now these ones, because of the weaknesses of the FRS IS 17, where we had the off-balance sheet item, you know, so the business people are now required to bring this one on board, and they can actually affect the financial ratios or the health of the businesses. So we are going to look at how that can happen in our future presentation. Classification of leases. So leases are classified into two. There are finance lease and there are operating lease. So finance lease is the one which substantially transfer all the risk and reward incident of the ownership of the asset to the lessee. So for finance lease, um, you are allowed to take all the risk and reward. For example, if it's a motor vehicle, you are the one to take all the risk. Insurance in Izako, everything is yours. Insurance, you have to take care of it, and also the benefit that's going to accrue is to you, not to the the lessor. Then for the operating lease, this one do not transfer substantially or benefit and risk of ownership. So for the 1 unit bedroom that you have leased, you don't enjoy all the benefits and the risk of ownership. For example, if the house is damaged, you can just move out and the landlord will take care of that. But for a finance lease, if the house is burnt, you have to take care of the damages. Indicators of a finance lease. How would you know in a given question that what we are discussing is a finance lease or is an operating lease? One, a finance lease or a capital lease should have the ownership transfer option at the end of the lease. So you'll see that at the end of the lease, there is that clause which indicate that there is a transfer of the asset. Then there is the bargain purchase option where as a lessee, you are allowed to bargain. For example, if it's a motor vehicle and that motor vehicle at a market value costs shilling 700,000. That is the market value. So you are allowed to bargain maybe and buy it at a lesser price, let's say 500,000. Then the other one, the lease term cover the major part of the asset used for life. If, for example, the asset used for life is 10 years, yeah, if the asset is 10 years, you can, and the lease agreement is around 8 years, then it means that is a finance lease. The other one, the present value of the lease payment is equals to the fair value of the asset. So if you get the present value of the future benefits of the lease and equate the fair value, the fair value is the value which can be assigned in the market. You find that they can almost be equal. So the asset is specialized and can only be used by the lessee. So the asset that we are talking about must be specialized. That is, it must perform a specific task and it must only fit or suit the business of the lessee. For example, construction equipment, uh, IT equipment, and some of the hospital equipment. Like in Kenya, there is this list of hospital equipment by a company called General Electric to all the 47 counties. So then we have some tests, or these are called capitalization tests. So the word capitalization means you need to include the asset in your books and you amortize it or depreciate it over a period of time. So what criteria would you use, yeah, to know whether you are going to capitalize this asset or not? One of the tests is called transfer of ownership test. So in the question that you are given, you'll find that at the end of the lease, the lessee is allowed to transfer the ownership. The other one, it is called the bargain purchase option test. And in this case, you'll see that the lessee has the option to buy the asset at a price significantly lower than the market value. So that's what I had just described how it can happen, where you can be allowed to buy the motor vehicle at a lesser cost, yeah, than what the market is offering. The other one is called the economic life test, or or simply the 75% test. And this one, the lease term covers a major part of the asset economic life, typically 75% or more of the asset used for life under the gap legacy. So now this one is where if the asset, for example, has a useful life of 10 years, then the lease is 8 years. You can see 8 years is 33 less than 100%. 5 years is 50%, then 8 years or 7.5, those are 25%. But 8 years is more than 75% of the asset useful life. The other one is called the recovery of investment test or 90% test. So in this case, the present value of the lease payment equals or exceeds substantially or typically 90% or more of the asset fair value at lease inception. So if you get the present value of the future payment of the lease, and then you compare that one with the fair value. So let's say the fair value of a motor vehicle today is around 1 million. So if the present value by 9 years or by 10 years, if you have leased a motor vehicle for 10 years, you find that the present value of those payments will be equal to almost the 1 million, then or 90%. Then again, that particular asset you should capitalize. So features of operating lease. One, operating lease are short-term or cancelable lease. So 1 month, 2 months, and if in any case you feel uncomfortable with that particular lease, you can cancel it at your own time. Ownership do not transfer. So if you have leased one bedroom or motor vehicle, there is no transfer. Then we have the lessor retain risk like maintenance, obsolescence, and residual value. So it is the responsibility of the landlord or the lessor to do maintenance of the house if there is any obsolescence, and especially on IT equipment, and if there is the residual value, that is the value that remain at the end of the lease payment. So um, the lessor will be expected to retain those particular risk. Okay. Then we have a table here where we need to compare the two leases. So we have um, finance lease and then operating lease. So we have talked about the ownership. For finance lease, there is that option to transfer the ownership. For the lessee or for the operating lease, we have said this one remains with the lessor. That is the owner of the property. The lease can reward. We have said finance lease does the transfer, but for the operating lease, um, there is no transfer of lease can reward. Balance sheet recognition. For finance lease, we have said it is included as right of use and a lease liability. For operating lease, this is off balance sheet, it is exempted. Depreciation for finance lease, it is done by the lessee, and for operating lease, it is done by the lessor. Then income expense recognition. So income plus interest, it is done by the lessee. Then interest and lease expenses are also done by the lessee. So that is that's the similarity of the two. Common use, finance lease is for the long term and operating lease is for the short term. So that is how we can be able to compare those two. Okay. Now, how do we account for finance leases by the lessee? Yeah. So this is another important segment where we need to be very keen. So number one, there is something called initial recognition. So recognize the right of use. So anytime that, for example, a contract is brought before you as an accountant, and already you have classified that particular lease as, let's say, a finance lease. So the first thing you need to do, it is to recognize the right of use of asset and lease liability at the present value of lease payment. So let's say the contract is for 5 years. Yeah. So um, you need to for 5 years, and in those 5 years, let's say you pay 5 million Kenya shillings. 5 years, and you pay 5 million Kenya shillings. So what you need to do here, the first thing, is to take the present value, of those lease payment for the 5 years. So um, you get the present value of the lease payment for 5 years, and that amount, the first journal entry is whereby you debit the right of use of asset, and then you are going to credit the lease payment, and we are going to see this practically how you can do it. Then that is the initial recognition. The second step is subsequent measurement. So the right of use, you need to depreciate it, and we have the lease liability, which will be increased by the interest and reduced by the lease payment. Again, we are going to see how that happens practically. So the journals at inception, the first journal at inception, we have said that you debit the right of use, then you credit the lease liability, and then subsequent, you have the interest, debit the right of use interest. Again, because of the interest will come from the discount rate. In a given question, it's normally provided, and again, we are going to see how this works. So you debit the right of use interest expense, then you credit the lease liability. Again, you debit the right of use, and then you credit the accumulated depreciation ROU. So again, we are going to see how this practically, just to enhance our understanding. So then we have accounting for operating lease. So for the operating lease, so we don't pass those journals. So generally capitalized under exemption, apply short-term or low value. Exemption cases, lease payments are recognized on a certain basis as expenses. So in most cases, what normally happens is that for operating lease, unless we have some exception, they are normally expensed directly. So if the lease is for 1 year, this year you are paying 10 million, so you can either do it on monthly basis or you can do it as a prepayment. So under FRS 16, short-term leases, they are normally exempted from capitalization, but under old IS 17, so here no asset or liability is recognized and lease rental treated as expenses. So the amount that you lease an asset, you treat it as an expense. Example, on January 1, 2021, on January 1, 2021, BC Limited signed a 5-year non-cancelable lease for a machine. Yeah. So the term of the lease called for BC to make annual payment of this amount at the beginning of each year. Starting January 1, 2021, the machine has an estimated useful life of 6 years and shillings 5,000 and guaranteed residual value. BC uses straight-line method of depreciation for all its plant asset. BC incremental borrowing rate is 10% and the lessor implicit rate is unknown. So required, one, what type of lease is this? So to determine what type of lease is this, you go to the 4 criteria that we have just discussed, and they are here below. So transfer of ownership, so you do that test, transfer of ownership. So in the question, there's nowhere we have been told that there will be a transfer of ownership. So transfer of ownership, you say no. There's nowhere we have been told about the bargain purchase option, so you say no. Then you go to the next test. So lease term. So lease term is for how many years in this question? It is for 6 years. The machine has an estimated useful life of 6 years. So 6 years is the life of the machine, and it has been leased for 5 years. So lease term is 5 years, economic life is 6 years, then the lease term is 83.3%, and that is more than 75%. And therefore, with that, you can say this is this is a capital lease. Then the next one is the present value of the minimum lease payment, and we have been told that in this question, the lesser implicit rate is unknown. So we cannot be able to get the lease payment in this case. But just using criteria number 3, you can comfortably say this is an this is a finance lease. And remember, in a question, yeah, where you are being asked what type of lease is this, you have to list these 3 4 tests and say what they are according to the question. The other one, compute the present value of the minimum lease payment. So we have been told that the term of the lease called for BC to make annual payment of 9968. So you have to get the present value of this. You have to get the present value of the lease term. The payment is 9968. And this payment have to happen at the beginning of the year. So at the beginning of the year, remember we can have the payment at the end of the year and at the beginning of the year. So where the payment is made at the end of the year, we normally have the ordinary annuity, but where we have the payment made at the beginning of the year, so we are going to have the ordinary annuity factor. So what we do is that we get the present value. We get the present value of the present value of ordinary annuity. Yeah, so we have the 10-year as the we have the 10% as the rate. So get that, and then you get the present value annuity for 5 years will be 3.79. So then you adjust so that you can make it to happen at the beginning of the year. So in that case, you normally add 1. So present value due will be equal to the present value annuity plus you multiply by 1 plus I, which will be equal to what you got there as present value annuity. You add 1.1 to get 4.1701. Then multiply by the annual payment. So the annual payment was 9968. You multiply by 4 to get 41. So at the end of the 5 years, this person would have paid 41,000. So what you are required is, how do you record this? The first entry, this amount is what you are recording as right of use. Remember, you can have you can have the formula direct, or you can do the wrong way we have done for looking at the present value annuity. So the general entry, you debit the right of use, and then you credit the lease liability with the same amount. Then you proceed and debit the lease liability, and then you credit the bank. So these are the payments that you have just seen there. So this is the amortization schedule. So on 1st of January 2021, this is the lease liability, 41,565. Then these are the lease payments. The lease payments are for 5 years, 1, 2, 3, 4, 5. Then we will have interest expense, and this we have this interest expense, which you get by multiplying the lease liability times 10%. So the first year there will be nothing, so you reduce the lease by the whole amount. The second year we will have that 160. The third year like that until the end of the year, and this amortization schedule should add up to 0 because you are continuing to reduce. But remember, what you do is that these payments that you make here, at the beginning, this payment that you are making here at the beginning, they are the one that you divide. So you know very well this is the pay. These are the payment. These payment are normally given, and they are the one that I have just described to you up there. They're in the question direct. So this 10% interest expense, it is on these balances that you can see here. So this amount and this amount, the interest expense and deduction in lease liability should be equal to this lease payment here. So because you know this amount here, to get this amount, you just less this minus this to get this amount here. Again, you get this balance here. This balance here at the end, take 10% of it, bring it here. Once you bring it here, again, take the lease payment minus interest to get how much you are reducing the lease liability. Then again, get 10% of this one, bring it here. Then again, get the payment that was made, less the interest expense, get how much are you reducing the interest with. You do that one until you get 0. So that is how we can do that amortization schedule. So the other journal, we have the depreciation expense. So this is the depreciation. So accumulated depreciation, you get the whole amount because we are depreciating this asset on a straight-line basis. So this is the present value divided by 5 years. So per year, you get the depreciation expense of that amount. Then you create the accumulated depreciation with the same amount. Then interest expense, again, this one you get it by getting the present value of the payment minus the first payment, then multiplied by 10%. Again, you debit interest expense, then you credit the lease liability. And this amount, everything you see here, it is on this schedule here. Then we have the payments. So for payment, you debit the lease liability. Remember, increase in asset, you debit, increase in liability, you debit, and vice versa. So in this case, the liability has decreased because you have made the payment. So debit the lease liability, debit the lease payment because you made the payment. Then you credit the whole amount with the cash because it's the cash which has been used in this case. Then we have the operating lease method. So if this was an operating lease, remember in operating lease we said that the payment you expense them. So you are going to debit the rent expense direct, and then you are going to credit the cash. And then in terms of to compare the capital lease with operating lease, you will appreciate that this is the capital lease, this is the operating lease. So for the operating lease, you'll find that there will be no interest expense. As you can see in this case here, there will also be no depreciation expense. Yeah, so no depreciation expense in the operating lease, no interest expense in the operating lease, and you can see the difference here. But at the end of the day, they are the same. So now let us look at the disclosure relating to the leases. So what are you supposed to disclose when you are dealing with a lease? One, you are supposed to disclose general description of the nature of the lease, the general description. So is it a finance lease? Is it an operating lease? Just a general description. Nature, timing, and the amount of cash inflows and outflows associated with the lease, including payment for each of the 5 years succeeding, amount of the lease revenue, description and the amount of leased asset, amount receivable, and an earned revenue under the lease. So these are just few disclosures that you are supposed to make in a financial statement regarding the lease as guided by FRS 16. So FRS 16 requirement. So previously as per IAS 17, lease accounting was split into finance and operating lease. Generally, operating lease was not included in the balance sheet as asset, but is simply added to the profit and loss account. So this one we have seen that operating lease was treated as an off-balance sheet item. So the biggest FRS 16 change is that now most of the leased item have to be included as an asset in the company book following a new right of use model which says that A contract is or contain a lease if it convey the right to control the use of an identified asset for a period of time in exchange of for consideration. So the biggest change between IAS 17 and FRS 16 is that the treatment of the lease. So initially, there was no right of use and lease liability, but under IFRS 16, then this coming on board. In addition, all the payments were made by the lessee on the lease agreement have to be reported as a liability on the statement of financial position. Again, this is another change where the payment have also to be recorded as liability. Initially or previously under IAS 17, that was not the case. The cost for maintenance, cleaning, etc. have to be separated from the main lease if they are included in the lease and reported. If they are included in the lease, including them and reported separate. So you don't have to include the maintenance and cleaning expenses. Added to this, the depreciation of an asset and interest on the lease liability have to be shown on the lessee profit and loss account. Again, we have said that for the finance lease, the interest payments and the depreciation have to be disclosed or to be shown in the P&L. So there are some few exceptions under the capitalization under IFRS 16. One, a lease with a shorter than 12-month term and which does not have an option to buy the leased item at the end of the lease. So if you have a lease and this lease is the tenure is 12 months or less, you don't have to capitalize. And if the value is too low, that is less than $5,000, again you don't have to capitalize. What exactly changed? That one we have discussed what exactly changed between IAS 17 and FRS 17. Basically, the change rotates or navigates allowed the treatment, the recognition of right of use of asset, and the lease liability. Then we have the concept of capitalization, that is the depreciation, recognizing depreciation, accumulated depreciation, recognizing of the lease liabilities. So those are the specific changes that happened. Um, we have we have come to the end of this lecture or this presentation. There are some few assignment with the solution. You can spend more time to look at them, and in case you have a challenge or you have a question, I'm always available. You can come back and maybe we can further discuss. So I'm not sure whether there's anyone with a question. Otherwise, mine is to appreciate those of you who have been able to make time for this class. I'll share the the recordings for those who have not been able to attend. Any question? So thank you and have a good evening all. We'll continue with our discussion next week. Sorry, Beth?
I just said likewise. Thank you.
Okay, all right. Have a good evening all.
You too.